Hey there, trader. I know.
Merry Christmas, you filthy animal, and a Happy New Year.
My friend, I am in a ratty mood today. I've got a headache, I literally just found a grey hair in my head, and I'm having to wear this silly Christmas jumper, which I'm not going to be taking off until after Christmas because I'm tired of being called a Scrooge all the time. But I thought of something that could put me in a good mood, and that's what I'm gonna do. Because I thought, first of all, I can help you guys out with something, and second of all, I can clear some stuff out of my inbox. Because you see, it must be that we're coming to that time of the year where people are planning for next year, and therefore I keep getting some similar questions appearing in my inbox every day. So I thought, rather than having to answer everyone individually, I'm gonna create a video about them and share with everyone. So the first question I keep getting asked is about trading targets, and we covered that in a video last week. So if you haven't checked that one out, go and check that one out. We released it last Friday. It might help you out. And the second question, and this is the one that everyone seems to be asking at the moment, my inbox is full of it. If you didn't guess already from the title of the video, it is of course, how much money do you need to start trading? So to answer this, in this video, we're gonna focus on Forex trading because there are some differences between asset classes. I mean, generally speaking, it's quite similar, but for example, with equities, you're gonna have extra transaction costs. With things like bonds, you're gonna need more money in general. So most of you trade Forex. Let's stick to Forex because it's more simple. So what do you think? How much money do you need as starting capital in a trading account in order to be able to trade Forex? And I don't just mean how much do you need to open an account and open a trade. I mean to trade sensibly. How much money do you think you need in an account? Now, I have to be honest with you. Some of the amounts that I've seen thrown around in the comments, in my email inbox, asking me is this a good amount to start trading with, have been completely ridiculous. And it may have been you that asked the question and mentioned an amount, and if it was, then please don't feel offended. You weren't to know, and everyone has to learn somewhere, but we're talking about like $500 or £200, or how do I take my paper round money and become a millionaire in the shortest time possible? Like, deep down, you and I both know that that's just not going to work. Believe me, I don't want to kill your enthusiasm. I want to encourage you to be trading well, but I need to make sure that you're doing this sensibly and in a way that's realistic. So I have to set you straight. You know, I see all these kind of junk messages coming through on our YouTube channel from people saying they'll take $250 and make you a reliable income every month. Believe me, it's not gonna happen. So I don't want you to feel discouraged, but at the same time, let's be realistic in this video. Let me tell you a little story about how I got started with live accounts for trading. Because, as always seems to be the case, I had to learn the hard way with this. Now, firstly, at the time, I probably wasn't ready to be trading on a live account. My trading was hit and miss at best, so I probably could have saved myself a hell of a lot of headache by actually trading on a demo account. But for the sake of the story, we'll forget that I wasn't a consistent trader in this instance. So all those years ago, what I was basically doing is putting as much money as I could afford into my trading account because I really believed in it. So that was coming from my monthly wage. Let's say it was something like £500 a month. So every month I got paid and I put £500 into that trading account. Now, rather than saving that money and letting it accumulate into a bigger pot of cash to trade with, I'd actually be so eager that I'd get started right away with my trading. So I'd take that £500 and I'd start executing trades in the live markets with that small amount of money in the account. So there I am with £500 in my trading account. And can you imagine what happened next? Well, let me tell you, I definitely didn't become a millionaire from that £500. In order to trade with that £500, just at like the minimum contract amount, I had to be over leveraged and overexposed. So yes, sometimes I might have some great performance and start racking up some more money and be like, yes, ka-ching. But then all it took was 1 or 2 losses, which is inevitable, you're gonna lose at some point. And because my risk profile was too extreme, then I'd burn out a load of that account. Rather than losing the 1 or 2% that we say you should lose at maximum on a trade, I was risking like big chunks of the account, so it only took a few trades to pretty much lose the entire thing. So I'd lose that £500, then I'd get paid the next month, take that £500, put it in a trading account, lose that, and do it again the next month and again and again. You know Einstein's definition of insanity, doing the same thing over and over again and expecting different results? Well, for those of you that had an inkling that maybe I might be a little bit mental, that confirms it for you. So after a while of being stupid and doing this over and over again, I started to realise that I must have burnt through a few £1,000s, and if I just waited, I would have had that big chunk of cash to trade with in the first place. Not only would this have been more beneficial to me because because as we both know, the more money you have, the more money you can earn. But also it would have allowed me to have a more conservative risk profile and more in line with what we always say, which is that you should only ever have 1 to 2% of the account at risk. Now you get the chance to learn from my mistake there and not do the same thing. Because of course, if you're really eager to get started, you can throw a few £100s or a few $100s into a trading account. Of course you can. But eventually you will lose that money. And if you can't afford to put more money than that into a trading account now, then I'm pretty sure you can't afford to lose that amount either. Alright then, so how much do you need in a trading account? Well, let's work backwards and see if we can figure it out. Our starting point is going to be that we know we want to risk a maximum of 1 to 2% of our account per trade. If we use an example of like Euro US dollar and use one standard lot, so one contract of Euro US dollar, we can start to figure out how much money we need in the account. I believe at the moment one standard lot of Euro US dollar is about £8 per pip, 10 euros. So let's say from your testing of your strategy, you've figured out that the maximum stop loss size from any of the trades you've done in the past was about 50 pips. So if we're going to be really conservative with how we're figuring things out, we need to budget for that 50 pips to be 1% of the account. 50 pips at £8 per pip is of course £400. So that £400 equals 1% of the account. That's what a stop loss is for 1% at risk of the account. So in order to find out what the whole account size is, therefore, we need to times that 1% by 100 to make it 100%, which is of course £40,000. I know that £40,000 is going to sound like a hell of a lot of money to most people, but we're being realistic here. I don't want to sell you a dream of thinking that you can turn peanuts into a mansion. I want us to be sensible about this and get you on the right track. So if that amount of money is too much for us, that we're never realistically going to save that amount of money, then what can we do to reduce that? Well, of course, we need to make adjustments. But when we make those adjustments, we need to make sure that we're not adjusting our risk profile. We don't want to get high risk with our trading just because we haven't got the starting capital. So we're going to make adjustments to everything else except our risk profile. So to start with, we said that we want to risk 1 to 2% of our account maximum per trade. But when we calculated that £40,000, that was based on 1% at risk. So what happens if we put it as 2% at risk per trade? Then of course the starting capital requirement drops by 50%. It becomes £20,000 that's needed. But if we're going to do this, we're going to do it in a smart way. So we're not just going to say that we put 2% at risk on all trades, full stop. No. What we mean is that if you have a basket of trades, basket of opportunities, and there's some that you would have risked 0.5% of your account or 1% of your account because they may be slightly more risky, and then there's ones that are less risky so you're willing to risk more of your account on them, like the 2% ones, what we're going to do is reduce that basket and say you can only open those low risk opportunities where there's a high success rate, less chance of it going wrong, and you are happy to put 2% of the account at risk on those ones. And all of the other trades, the 1% ones, the 0.5% ones, they're gone. You can't trade them because you don't have the capital to do them in a low risk way. So in other words, we're restricting our trading and we're being very, very cautious because we know that capital is a problem for us here. Next, we said from our testing, we may have seen that, for example, the maximum stop loss we needed on any of the trades was 50 pips. Now, what if we reduce that by half? So we actually make it 25 pips as the maximum stop loss. Now, in the same way we did with the 1 and 2% of the account at risk, this doesn't mean that we set our stop loss as static for all trades. The stop loss is still always associated with the setup, so the setup dictates the size of the stop loss. But what it means is that if there's an opportunity that requires a stop loss for above 25 pips, it's a no-go for us. We can't execute that trade because we haven't got the capital we need. So we're only allowed to go for opportunities that are 25 pips in the stop loss and below. So now, by restricting ourselves with those two rules that we've just discussed, we've managed to reduce our capital requirements to £10,000. But what happens if you lose some trades? It's inevitable that you're going to lose some trades, and if that £10,000 is the minimum capital requirement, if you lose a trade, you're below the minimum capital requirement. So we need a buffer.
Let's get ready to...
In a previous video about drawdowns, we agreed that we want to aim to have a maximum drawdown ever of 20% of our account. So if we take that 20% and try and figure out then what capital we need, we end up with £12,500, because a 20% reduction on £12,500 will equal £10,000, which is of course the minimum capital requirement for us. So that gives us our buffer to have the drawdown of 20%. Now realistically, these are the only restrictions we can make. So based on these, that leaves us with a minimum amount that we need to trade one contract of Euro US dollar as £12,500. And that's if we're going to be risking 2% of our account on each trade with a maximum stop loss size of 25 pips. And that means that you're very restricted in the opportunities you can take, which is not ideal for trading because sometimes you're going to get tempted by the other opportunities. So what else can we do instead? With a lot of major brokers these days, you don't actually have to open a full contract. They also will let you open portions of a contract. So for example, you can open 0.1 of a contract for Euro US dollar. And some brokers even let you go as low as 0.01. So what we do in this case, if we want to trade 0.1, we take our starting capital of £12,500 needed to trade one contract of Euro US dollar, and we divide it by 10, which gives us £1,250 as the starting capital as a minimum, with that buffer to trade 0.1 of a contract per trade. Obviously we can go lower to 0.01 of a contract, but I strongly suggest you don't do that. And let me tell you why. To put it very simply, you need to be remunerated for your time. If you're trading 0.01 of a contract and you're making 8p per pip in the market, then you would make more money working minimum wage somewhere for the amount of opportunities you're going to get. So you might as well actually go and spend that time working somewhere, using the money that you earn and putting it aside so that you can build up a larger trading account. You see, 0.1 of a contract, that's one thing, it's still quite low, but you can make a decent second income from that. You can have some decent pocket money to go and spend and have a nice life by trading 0.1 of a contract, or use compounding returns and build it up. But you see, you could do compounding returns with 0.01 of a contract, but the thing is, it becomes such a small amount then that you're trading that it's almost like it's negligible, which means that you're going to be more willing to put on more risk because you see it as, oh, it's only like 32p that I'm losing here or something like that. And it means as well that you're not going to be taking it as seriously. After a while as well, you're going to get so sick of earning 63p per trade that you're going to be like, okay, let's max out this account. Let's see how big I can go, how overexposed and how much money I can make from a trade with a small account. And when you start doing that, your money's going to be gone. So my friend, this is just my way of calculating it. Other people have their own ways of calculating what the minimum capital requirements are, but based on my experience, based on what I see as being sensible, based on the rules we discuss all the time about risk and that kind of thing, and based on what I've seen other people doing, this is what I truly believe is the right way to go about calculating it if you want to understand the minimum requirements. Now, if you didn't understand anything in this video, please send me an email, leave a comment below to ask for clarification, because this is a really important subject and I want to make sure that you understand it properly before you start trading live, because I don't want you to risk burning out any accounts unnecessarily. If you have any comments, if you disagree with anything I've said, leave a comment below, let's discuss it. If you like the video, make sure you hit that like button down there. If you do hit the like button, you're going to be on Santa's good list, and we're right by Christmas now, so get some festive cheer going. If you want more videos about learning to trade, make sure you subscribe to the channel. And if I don't see you before,
Merry Christmas, you filthy animal, and a Happy New Year.